TheoTrade, this is Don Kaufman. It's March 8th, 2019, and you are watching the TheoTrade Weekend Update. Let's begin with some broad discussion of the overall markets, the economy, some of the numbers that came out this week. Then we're actually going to whittle down to some of the specifics, some trade ideas, really some very specific ideas inside of a couple of major products right here, right now, even a couple of specific levels inside of the broader S&Ps. So let's begin with the SPX. So the SPX this past week, well, we started the week right around 2,800, pretty much 2,803. We ended the week right at 2743. So we saw just about a 60-point move inside of the SPX. Now, what does that amount to? Why am I mentioning it? Because the expected move in this past week of trade was only $33. So that's what the options market depicted us to move, which was 33 bucks. The actual move was right around 60. What do we get? It's 2 times the expected move, or a 2 standard deviation move. This is what I've been barking about kind of week in and week out. I'm like, don't sell options premium. You're going to run right smack into a brick wall. Obviously, this is kind of coming to fruition as volatility kind of came back into play. I wouldn't say volatility is necessarily raging. So we're going to show you here in a couple of moments, we didn't see the VIX exploding to the upside. We didn't see the VVIX necessarily like on fire. Before we get to any of that, before we get to any of the specifics, let's get down into really some of that bigger data. And more importantly, I'm going to start with a discussion about the yield curve. In a moment, I'm going to show you actually a graphic of the yield curve. The yield curve itself. The yield curve is inverting, and if you're not familiar with that, what it categorically means is obviously recession, or has meant recession. Although previous results are not indicative of what's about to happen. Nevertheless, the last couple of times the yield curve has inverted. This has really been, quite frankly, the only indicator that has about 100% track record. So, a few weeks ago when the yield curve kind of first inverted, a lot of people said, it's the Fed, it's this, it's that. Yeah, but now the yield curve is inverted, and today went even further in terms of its inversion, but now there's data to back it up. What's some of the data? So we can look at some of the German data that came out in factory orders. So German factory orders were expecting 0.5%. Instead of 0.5%, they got negative 2.6%. Ooh, that was not good. China exports were down 20+%. That was not good either. All right, we'll push that one aside for a second. A major Chinese brokerage firm came out with a sell on all of Chinese markets. And you have to recognize what that effectively means. The Chinese ultimately, to get a sell on really from a brokerage firm on the entire marketplace, they would have had to have government approval. So apparently the government approves, so we should sell Chinese stocks right now. Again, we're looking at all of this macro data, and I'm just going over it, really, really superfluous right now, just to make a point, okay? Everywhere you look is slowing down. Everywhere we look. Now, the third point that I want to make is everything about the ECB. That's the European Central Bank, of course, headed by none other than Mario Draghi. Let's remember where Mario Draghi comes from. Italy, which is effectively in a recession. Mario Draghi is also coming towards the end of his term. And I've made this point before in the TheoTrade chat room, and I'll make it here for this video. I don't believe Mario Draghi is leaving the ECB without first juicing the economy. So in the last 3 months, the ECB has done a complete and total 180. All right, they're over there, hands off the economy. Let's actually, pull back a little bit of the quantitative easing there, of course, in Europe, and now they're once again full force. Not only are they not raising rates, but they're actually having their banks in long-term lending and juicing that once again. So all of this kind of lends itself to the fourth point over here. This is kind of what we termed and have termed the Goldilocks scenario. And this is that kind of the big, overwhelming question that I want to get to on this video. And then we're going to show you some not only macro data, but as I said, kind of go down into some very specific trade ideas. When I talk about this Goldilocks scenario, it kind of means, the worse economic data happens to become, all right, the more the central bankers step in and just, hit the accelerator and force more liquidity into the economy. Everybody loves it. Everybody cheers. Sooner or later, the marketplace turns it back. It will turn its back on those central banks. Okay? Are we at that tipping point? With that, let's get into it. Let's look at some charts. Let's see if we can decipher just that. Is the market right now turning its back on the central banks? To the charts and trades we go. Let us begin here in the SPX before moving on to a little bit of discussion specifically about the yield curve. Then we're going to look at a lot of individual products out there and finally kind of wrap up with answering the question, is the market right now starting to turn its back on the central banks? So as I was saying, beginning here inside of the SPX, what we have this particular week is a breach of the expected move. And again, these three lines, the central line represents the start of the week. The upper end of this, okay, it's the upper edge of the expected move this past week was about $33 higher or $33 lower. So we're looking for this move, $33 higher, $33 lower. Actual move, well, we started the week at 28.03. We ended the week, well, right here, which is 27.43. That, people, is a 60-point drop inside of the S&P, as it's good for about 2 sigmas, what we term 2 standard deviation move. Now, okay, that's great, yada, yada, yada. I'm not a complete geek. What does this really mean for me? I'll tell you exactly what it means for you. When you see a breach of expected move this big, and again, this little highlighted candle, I highlight that. I highlight anytime they breach the expected move significantly. So you can see, all right, we had a big breach of the expected move. Even though we rallied back up today being March 8th, we still had a big breach of expected move. Now, what that would lead you to believe would occur, okay, would be a major expansion, if you will, of volatility kind of moving forward. Why do I say there should be a major expansion? I don't know. You breach in 1 week, you would expect, hey, things kind of picked up a little bit. The market, okay, when it breaches this expected move, what it's saying is the market didn't get it right. All right, the market wasn't good at handicapping risk this past week, and let's do it better this next week. Let's really expand, okay, the implied volatility out. Now, what is this next week? Like, what are we going to see in terms of an expected move? Okay, and that answer comes to, all right, if you take a look 7 days out, you're looking at about a $43 expected move. What do we get? Well, we went from a $33 expected move to a $43 expected move. Let's just call it, about a 25% bump up in implied volatility, give or take a few percentage points. So volatility increased, but not substantially so. It doesn't make me want to run out after seeing a breach by double. And again, drastic 60-point move. Now this entire next week, you're telling me the entire next week of trade, I'm only supposed to have a $43 move higher or lower. And once again, I will reiterate something I've been talking about week in and week out, the implied volatility. And I'm just going to highlight this for a second. The implied volatility, that's the IV, okay, versus the HV, which is historical volatility. Here is what we call the juice, and that juice might not be worth the squeeze. What effectively I'm saying is that the implied volatility, yeah, you can go out, you can sell options, and maybe it'll pay you, but it's not worth it given the fact that the historical volatility, which is actual movement, seems to still be, in many cases, outpacing the implied volatility on a week-to-week basis. It doesn't exactly give me like warm and fuzzy feelings to want to go out and to sell options premium right now. And again, I will reiterate my stance. Not only do I not want to sell options premium, but again, I'm still looking to, on any bounce back to the upside, I'll be looking to buy more options premium. Now remember, I'm an individual that I built my career around being a premium seller. And now I'm actually on the other side of it saying like, no. Right now, the markets are so incredibly efficient, historical volatility versus implied volatility, that I actually want to be an option premium buyer in most cases. All right, enough there. Okay, so in the SPX, we don't necessarily want to sell premium. The implied volatility's picked up. But as I said, it was kind of a lackluster pickup in implied volatility. Like, take a look at this. This is the VVIX, the volatility index. Now, I told you, okay, weeks ago, there was a spike in the VVIX. In fact, right here is where we saw this spike all the way back here on February 25th, and we went nuts. We actually put on a bunch of VIX trades in that time frame, which, by the way, are coming to fruition quite nicely here in the VIX. The VIX did pop back to 1605, but it's not exactly getting it done. The VIX at 16, it's a yawner, right? But I've got, again, multiple positions and multiple expiration cycles, just spreading out a degree of risk as the VIX has tried to stage a little bit of an up move. But again, it's kind of lackluster. If this is volatility, okay, if this is the beginning of volatility, we ain't seen nothing yet. And I'm not entirely sure that this is going to remain. Now, move past a little bit of the volatility. Let's go jump over and talk a bit about the bonds. The bonds have reversed course. Now, the bonds themselves have rallied. What does that do effectively to the interest rate or the yield? Okay, so for that, we'll pull up what is called TNX. Now, TNX, this happens to be effectively the 10-year Treasury. The 10-year Treasury, all you've been hearing about, by the way, this is a 9-month chart. Just do me the favor for a second. I'm going to pull up 1 year. Okay, all you've been hearing about for the last year, okay, is everything from, politicians to the Fed to everybody is talking about they're raising interest rates. It's going to put pressure on the market. By the way, here's the 10-year. Did they raise interest rates? Here's a year ago, and here's right now. You do some math. That looks like a little bit of a downward trend there in interest rates. So even though, okay, the Fed is talking about raising interest rates, the 10-year, okay, which is further out in terms of duration, has effectively gone down over the last year, which brings me to the actual yield curve itself. Now, this is where things get a little dicey. This is the Department of the Treasury website. You got to love it. There's no advertising. There's no advertising on the Department of Treasury. Hey, maybe the Department of Treasury should advertise a little bit. They can make a couple of bucks. All right. Making money any other way. The issue that you've got right now, and that's really starting to become very disconcerting. So let's start by looking right here at the 3-month. Okay, if you look at like a 3-month, you're like 3-month what? All of this is what we term paper. It's debt, it's paper. Whether it's 3-month paper, whether it's 3-year paper, whether it's 5-year, 7-year, 10-year. Okay, you saw an interesting trend in just the last, we'll call it like the week plus of trade. This is 2.44. It's kind of trickling to the upside. So the 3-month is trickling to the upside. So short duration, again, short duration, and it doesn't look like much, okay? But it matters because that short duration in a lot of cases, all right, whether you're looking at 3-month or, for instance, whether you're looking at like 1 year, which is now trickled up to 2.53, it's starting to exceed, for example, okay, 5-year. So you actually have, at this point in time, the 3-month paper is, what? It's above, okay, the 5-year. It's pretty much at par with like that 7-year. In fact, the 1 year is now above the 7-year. So what you have is, during quantitative easing, the curve looked like 0 and then looked like this, right? So the yield curve, the further you went out along the curve, the higher the interest rates went. Now this thing looks like what? It's actually slightly inverted. It's ever so slightly inverted. I mean, 1 month, okay, 1 month is now above 5-year. Think about that for a second. I know I'm making a mess drawing this over here, but again, if there's one indicator that has been effective 100% of the time, and I hate to give this, it's not a holy grail indicator, but here we do have an indication that we are headed towards a recession. Now, clearly, Italy has actually claimed recession. Germany has actually claimed that they just got through what was unscathed. However, today's data is, and the factory orders out of Germany is probably an indication, most evidently, that they're in a recession at this point in time. China is definitively in a recession, although would be the last one to effectively mention that. And here we are with one of our primary indicators actually displaying at this point recession, which I don't necessarily think is coming to fruition, has come to fruition yet, but it's something, it's macroeconomics to seriously consider. Because before I go any further, and I'm going to talk about a couple of products here momentarily, I want to talk about this kind of Goldilocks scenario. The Goldilocks scenario says, for all intents and purposes, the worse the data is, the more the Fed is actually going to step in. As the Fed steps in, okay, what you're going to get is liquidity, all right? However, we have an issue with that. This week we had absolutely terrible data, and the financials came off hard and fast. It's not a good sign. It's not a good sign at all, because the financials, again, in terms of big sector, financials are really what sparked a lot of the sell side activity inside of the S&Ps. Call it whatever you want. I know a lot of people are caught up in like technology, please, technology barely moved down this week, right? It's all about the financials. And I've been talking ad nauseum about this very specific, this 2650 level inside of the financials. Hit that 2650 level a few weeks back, have been migrating in and around it, came off of it hard and fast. Granted, we reversed back higher today, but the financials are in serious trouble. And that's where I came up with this broader question, with the Goldilocks scenario. If things are going to be good, effectively, if the Fed is going to come in with a rush of capital, okay, then the financials are going to remain rather unscathed, but that does not look like the scenario right now. In fact, I'm going to take you to a one-year chart for just a moment. On this one-year chart, I'm going to come down to style and load up a style for you because I think that this is incredibly important to see. It's actually a style that I've built some time ago. It's a sector comparison. And the sector comparison is done over the last year of trade. It's just a last year of trade. Please, if you've seen any of the videos I've done, you've seen me do this before. It's the spiders versus, well, a ton of stuff. Like what's the ton of stuff? Okay, I've got everything from the financials on here. I've got, XLU on here. I can go on and on, all the different sectors. So there's XLU is the outperformer. Okay, I'm a little bit cautious simply because the XLU, what is the XLU? It happens to be utilities. People are dumping money into utilities. I'm going to come back to that here momentarily. Okay, the underperformer at this point in time happens to be the XLF. Okay, financials clearly see something, and again, in a marketplace that's supposedly up and up big, well, it might be up in the beginning of 2018. Effectively, most of your major sectors, okay, are either flat or down, and this is year over year. Okay, this is again where the year began. Most of your sectors are flat or down year over year. What's the sector that's up? It's the XLU. In fact, with that, let's go take a look specifically at the XLU, kind of clear the chart over here. Why am I looking at the XLU? It's an incredibly defensive opportunity for a lot of people. The XLU, okay, it's the utilities. Like when was the last time like you saw utilities doing this? There's a rush into the utilities. Now, granted, there's been a rush into the entire marketplace. Year-to-date percentage is about 10.65 inside of the utilities. This hasn't backed off an inch. But when you start looking at the utilities, okay, it's almost like the marketplace has been pricing. Again, the marketplace looks like it's been pricing for the entire last year, either a recession, okay, or the fact that there's going to be yield starvation. That is, people are starved for yield. So what are they doing? They're dumping capital, okay, into a place they know is going to have yield. The scary thing about the XLU, these utilities, is they're supposedly low beta. Look, they have a 0.24 beta. Does that look like a 0.24 beta? This is insane. 0.24 beta doesn't move 10% in a couple of weeks. Okay, you got to realize what we're actually saying here is that the idea of like beta and beta portfolios is out the window right now. Okay, your risk is so much greater. Okay, if something like the utilities has the possibility of moving this much, okay, it has consequences for the entire marketplace. Now, with all of this, and again, we're talking about this Goldilocks scenario, and yet money is flowing again like water into things like utilities. Again, what we would construe as highly defensive in terms of sectors. It's one of the things that I would say is it's a shot across the bow for this Goldilocks scenario, not necessarily working. Again, that Goldilocks scenario is the Fed comes in and saves the entire world. Sooner or later, okay, the markets very well may turn their back on that. And with that thought, you got to look over at like EW, we'll actually look at EWJ. I think that no conversation would be complete with the Goldilocks scenario without looking specifically at what is EWJ? It's Japan. It's Japanese ETF. And the reason I wanted to pull this up is this is exactly a 20-year monthly on here. Listen, it was actually back in 1999, right there, back in 1999, when they first brought interest rates effectively down to zero. Of course, they're in negative interest rate territory right now. The irony is from 1999 to right now, okay, this particular ETF is up a whopping $3. Just wanted to throw that out there for your consumption because the Goldilocks scenario works until it doesn't. And remember, this is Japan. Japan has been buying their own ETFs. You're buying your own ETFs, and over the last 20 years, you're only up $3. Okay, doesn't bode well for the future. That coupled with the fact that again, capital is flowing into low beta products everywhere, low beta, high dividend paying people. All right, this is duck and cover kind of territory right now. Now, moving forward, a lot of the positions we currently have on, well, this week they're all working. What kind of stuff have we talked about literally in the last couple of trading sessions? Well, 2 weeks ago, we talked about the most important stock in the marketplace, Boeing. All right. I've actually maintained a short position in Boeing for a considerable period of time. Listen, this is a nothing move right now. It's an absolutely nothing move. We're not claiming victory in any way, shape, or form in here. So what? The stock's down over 20 bucks this week. Okay. Call me when this thing is down to 300 and I might be relatively enthused. And I'm deadly serious about that. The 300 level before I'm going to get enthusiastic about this. It's the single most important stock and remains the single most important stock in the markets. But I wanted to bring it up because the marketplace as a whole isn't falling unless Boeing is actually falling. Next on the list over here, you got to look at XLF. As I mentioned a moment ago when we brought this up, XLF, okay, backing off in a big way. But there's some opportunity in here, and I'm going to show you where some opportunity lies. Goldman Sachs, it is not backing off as strongly as the rest of the financials, nor, okay, is Wells Fargo. So if there's going to be opportunity inside of the financials, consider to the short side, Wells Fargo and or Goldman Sachs. I'm going to be looking at those as the week kind of progresses. The next one that we made a point of, okay, literally this week, had everything to do with XHB. It's the home builders. Okay, we actually took a short position inside of the home builders. That is effectively working. Again, these are just some of the recent videos we've done. Took a short position in the home builders. And I will continue to sustain the short position in the home builders. I have a deep in the money put on that one. It's just a synthetic short position. The next one over here, FXI. FXI, it's China. Now, the whole argument in FXI was a very simple one. Okay, the Chinese markets exploded to the upside, so much so it was actually becoming dangerous for China. Okay, the sovereignty is becoming dangerous for China of overheating their marketplace. So I just took a very simple assumption. Sooner or later, the Chinese government's going to step in, okay, and not support the market. Well, that happened this week. It's down and down big. There's no opportunity in here. Chicken's done. Either you're in it or you're not. You can see I've got positions out some 70 days duration position, okay, but at this point in time, hold it. I'm just reiterating like a position here, hold it. All right, we've already gone through XLU, which we talked about a little bit. Now, other areas that I'm watching very, very carefully in this particular case. All right, I'm looking for opportunities in retail. Specifically, I'm still looking at XLY. Now, a little bit more of reversal back to the upside. Anything above 110, and I may actually step in and short it. You got to realize that in a marketplace that's backed off, and we just went through, a slew of products there in a short amount of time. In a marketplace that's backed off, okay, quite rapidly in this past week, okay, you don't want to step in and short into the hole at this point, okay? I've been getting 24 emails literally today. People are like, can you save me? Give me a risk twist spread. Give me an atomic hedge. Listen, there's smoke out there. And when there's smoke, you don't go out and try to hedge. The hedges are either on 2 weeks ago, on a week ago, okay? Or you're left pretty much in the cold. You can't go out and try to buy volatility in the midst of volatility. It's kind of like buying homeowners insurance when everybody sees smoke coming from the house. They're going to laugh and raise the price, right? And the exact same thing is going to happen in this marketplace. So we can't try to short into the hole. So what we do is we start going through, okay, our lists. We start going through scans and we try to find products that are kind of contrarian. If we think the market's going to continue to fall, let's find pockets of strength and sell into those. Again, this coming week, I should say, the expected move, it's kind of lackluster. Again, with a $43, $44 expected move, I'm not going to be out there selling premium. I'm going to sit back, take some opportunities as they come. As I said, I'm going to short opportunities as they actually pop back to the upside. We're also going to keep a close eye on this bond market. There's just no question. The bonds right now, they're in play. Okay, they're in play because the bonds are going to display, if you will, okay, recession, if that's the way that this is going to effectively play out, whether it's the ZB or the ZM. We're also coming into the triple witching. Some people will call it a quadruple witching. It's not a quadruple witching. It's a triple witching week. That is when the futures are going to expire. The index options expire. There's a normal, weekly expiration as well. So we're going to have a triple witching. Don't panic about it. We'll talk about it a little bit this week on TheoTrade. With that, have a wonderful weekend, everybody. Bye-bye.